What's up, YouTube? This is Thomas from Thomas Invest and thank you for watching. Today I want to talk about Kroger, ticker symbol KR. Kroger is an American retailer with more than 2,700 supermarkets, 140 jewelry stores and 1,600 fuel centers. This company is loved among the investors because of several reasons. In this video I will show you what Kroger does, some interesting facts coming from the 10K file and the investor presentation, and in the second part I will talk about the fundamentals and if I'm going to buy Kroger right now. In the last part I will show you a few competitors. In the end of the video you will know everything about Kroger and can make a fair decision whether to buy this company or not. If you're new to the channel, make sure to subscribe to get notified when I'm posting a video. I also appreciate an early thumbs up, which helps me within the YouTube algorithm. For now, let's dive into it. So first of all, Kroger is the leading American grocer, with more than 2,700 supermarkets operating under several banners throughout the country, as mentioned before. Kroger features a leading private label offering and manufactures around 30% of its own brand's units and 40% of its grocery own label assortment itself, in 35 food production plants nationwide. Kroger is a top 2 grocer in most of the major markets and all of its sales come from the USA. If we check some other retailers, we see that a lot of them are also operating in the other parts of the world, represented by the dark blue percentage in this chart. We see that Kroger is 100% generating its sales in the US. In this infographic, we see that Kroger is active in 35 states and have 9 million daily customers. As mentioned before, Kroger has more than 2,700 supermarkets and more than 2,200 pickup locations. Here we see that roughly 54% of the total revenue is generated by non-perishable, meaning groceries, general merchandise, natural foods, and health and beauty and care. 25% is coming from fresh products like floral, meat, seafood, dairy, bakery, etc. 7% is coming from the supermarket fuel. 8.6% is coming from the pharmacy, and at last but not least we have 5% coming from other things. A really interesting thing I ran into in the factbook is the own brand part, or as they call it, our brands. Kroger has loads of data about the products, customer behavior and all other stuff. They know exactly which type of products are interesting to create to an own brand. By creating an own brand, you can reduce the cost and increase your margin. This is very interesting for companies like Kroger. The own brand plays a huge and important role in the merchandising strategy. On average, the supermarkets have over 15,000 private label items within the store. Kroger primarily produce and sell 3 quality tires, plus, natural and organic, and they try to increase the assortment every time. We see that back in 2011 the own brands represented a 15 billion in revenue. In 2020 they represented a 26.2 billion in revenue, meaning roughly 74% increase in revenue, while their overall revenue increased by roughly 60% since 2011. This means that the own brands are growing higher and faster in revenue than the overall revenue itself. This is a really nice thing in my opinion because of the higher margins, of course. Back in 2011, the profit margin was sitting at 1.36 and right now it's at 1.96, a big increase and also made possible because of the own brands. In here we see the capital investments made by Kroger. In 2020, we see they spent 50% of the money to increase the margins, while in 2019 they spent 10% of the total money to increase the margins. Another great thing I like to see is the 90% investment they made in digital acceleration. This enables the sales to grow even more. From these numbers, it's a small step to the fundamental part of the company. But before we check every fundamental aspect of the company, I first want to take a look at the stock price. The interesting thing here is that the stock is up 0.7% year to date, while most of the stocks are down year to date because of several reasons. But the stock is 8% down from the all-time high this year, also because of several reasons. I do own shares of Kroger and I'm roughly up 25% right now. I think there is still plenty of room to grow for Kroger in the coming years, so I'm not planning to sell very soon. Besides, they pay a really decent dividend, but let's talk about the dividends at a later point in this video and first focus on the fundamentals. Kroger is a 33 billion market cap company with an enterprise value of 50 billion. The current PE ratio is sitting at 34, which is pretty high for a company like this. Microsoft has a PE ratio of 30 and has more recent growth and also more potential growth in the future. So this is something you might want to investigate deeper. Personally, I think for a company like Kroger, you should aim for a P/E ratio between 16 and 22. Kroger has an operating margin of 1.95% and a profit margin of 0.75%. Both not that high, but as we saw that the own brands of Kroger are responsible for increasing profit margin, which is really nice. Besides, Kroger invests money for better margins, which we also saw earlier in this video. I think they really need to increase the profit margin, but it's also very typical for companies like this to have a lower margin, so I don't worry that much about it. As I said, it needs to increase somehow. Kroger has a return on assets of roughly 3% and a return of equity of 10%. Both are fine for a company like this because you cannot expect high numbers here. But it has to be said that the ideal situation, you want both of these numbers sitting at 10%. So it would be really nice if they are capable of increasing the return on assets in the future. Here we see the revenue growth of Kroger since 2006. It's going up really nice and steady. You want this number to increase organically and not only by opening new stores. In this chart we see that the total amount of stores Kroger has isn't increasing that much lately. So this comforts me a lot. You want them to grow organically because they are a better company versus the competitors and not only by opening more stores. If we take a look at the balance sheet, we see that Kroger has a total cash of $2.30 billion. Kroger also has a total debt of $20 billion, which is quite a lot. On the other hand, debt is used to grow, so I don't think this is that big of a problem. Kroger has a current ratio of 0.8, which is very nice to be honest. Most of the companies operating in the same industry have a lower current ratio because of all the stock they need to have. In the best situation, you want this number sitting around 1, so Kroger is almost there. Another great thing I like to see is the amount of shares outstanding. This number needs to be decreasing every year and Kroger is doing a tremendous job in here. So the red sticks you see in this graph are actually a good thing. Decreasing your shares outstanding is a way to create a lot of value for the company and also for the investor itself. With decreasing shares outstanding, the shares become more valuable because there are less shares to own, quite obviously. This means a higher EPS in most of the cases, which is also attracting other investors. And with less shares outstanding, the price will go up even more. On the other hand, with less shares outstanding, the total amount of dividends that needs to be paid to the investors will also be lower because there are less shares. When the total amount of dividends paid is going down, there's more room to invest that money into the business again or to increase the dividend. This also brings your payout ratio down. So only good things come from buying back shares. And it has to be said that Kroger does a really good job here. Since we're talking about dividends anyway, Kroger is also known to be an interesting dividend payer. Kroger pays a dividend at a 1.84% dividend yield, which is pretty decent I think. The payout ratio is sitting at 21%, which is great in my opinion. Roughly 80% of the total free cash flow is used for other things like buying back shares, do acquisitions, research and development, and of course pay down debt. The 5-year growth rate is sitting at almost 12%, so that's also pretty decent. And they grew the dividends for 15 years in a row. All these numbers look really steady to me and there's enough room to grow the dividends, and that's also a really nice thing. Next up are the competitors. Kroger is in an industry where there are a lot of competitors and every company wants to be the biggest, cheapest and also the best. In this part I will show you a few competitors which I think are the most relevant. I will show you the PE ratio, the revenue growth over the last years and also the dividends they pay. I won't do a deep dive in the competitors, but I just want to show you some other options. First on the list is Costco Wholesale. Ticker symbol COST. Costco is a $227 billion market cap company with a PE ratio of 43, which is quite high. You want this number sitting around 20, as said before. In here we see that Costco has a better profit margin compared to Kroger, and both return on assets and return on equity are higher, also compared to Kroger. The revenue is growing really steady and has only go up. Same story as with Kroger again. So both companies are doing a really great job. You might want to check how the growth is developing. Are they opening a lot of new stores or are they growing organically? This is something you have to figure out yourself. Costco pays a low dividend of 0.6% dividend yield and has a payout ratio of 27%. The dividend yield is lower compared to Kroger and the payout ratio is higher. Kroger definitely is the winner in this one. The growth rate is similar to Kroger, also sitting at 12%, and the amount of years increasing the dividends is also similar, but Costco is sitting at 17 and Kroger sitting at 15. Overall, very similar statistics on the dividends. I think you need to do a bit more research for this company. I don't like the PE ratio sitting at 40, but the margins are better, so that's something to think of. Next up is Walmart. I did own shares of this company, but I sold a while ago, because I thought there were better deals in the market. Walmart is a 371 billion market cap company with a PE ratio of 46, which is really high. The profit margin is looking good again, sitting at 2.4%. This is significantly higher than Kroger. Walmart has a pretty steady revenue growth, also similar to Kroger and Costco. Nothing special to mention here, only that it's looking really decent. Again, same story as with Costco. You might want to check if they are opening a lot of new stores or that they grew organically. Walmart pays a 1.6% dividend yield and has a payout ratio of 34%, so this number is the highest so far. A higher PE ratio means less money available for other investing things in the company. But it also has to be said that 34% isn't really that high, so don't worry. The 5-year growth rate is nearly flat, sitting at 2%, but they grew the dividends for 48 years in a row. Really impressive. At last but not least, we have Target, a 99 billion market cap company with a PE ratio of 15. This is looking really good. Target has the highest profit margin so far, sitting at 6.5%. Really looking good. Both return on assets and return on equity is also looking really good, so that's a good thing about this company. Target didn't increase their revenue all of the time, but since the Roni virus, it went up big time. This is something you might want to dive in deeper. Why was the revenue not increasing previously? Target pays a solid 1.76% dividend yield and has a payout ratio of 22%, both similar to Kroger again. However, the 5-year growth rate is sitting at 7%, which is lower, but the 53 years of increasing dividends in a row is really impressive. I think the most important part for this company is how they are thinking to grow from here, not only by opening new stores, but also organically. My conclusion is that Kroger is a really steady, decent company. The PE ratio may be a bit higher than we would like to see, but this company is really nice to have, especially if you had a good entry point. The revenue is increasing every year and they buy back a lot of shares. Dividends are increasing, so these are all great things in my opinion. There are a lot of competitors and they all look very similar to Kroger. Some has better profit margin and some of them have a lower PE ratio, but I don't think there's a significantly better company between all of them. As I said, I did own shares of Walmart and I decided to sell those shares and completely focus on Kroger because I think Kroger is the better company, and especially in terms of dividends. Only time will tell if that's true. For now I'm holding Kroger, but I don't think it's an interesting price to put in on a buy list in terms of valuation. If you are more a dividend player, then I think you got a pretty nice deal with this company because the dividends are looking really good. For now, I think I will slowly increase my position throughout the year to increase my dividend. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.